right, so Wyatt, what is a Qualified Opportunity Zone Fund?
A Qualified Opportunity Fund is a term of art under the Opportunity Zone Treasury regs and code section that effectively says it can be a corporation or a partnership organized for the specific purpose of investing in a qualified opportunity zone. So it's an investment vehicle. Should be distinct from your traditional private investment fund. There are some very distinct qualities of a qualified opportunity fund. Primary of which is the 90% test. The fund will be subject to a test every 6 months in which it must demonstrate that it holds 90% of its assets in a qualified opportunity zone. So what qualifies for that? Real property located in the qualified opportunity zone qualifies, but the fund will be required to demonstrate that it has redeveloped that property over a short period of time, 30 months after the initial acquisition of that property. So the fund must redevelop or double its basis, sort of 2x on what its initial investment was, in order for that real property to qualify.
Do operating businesses also qualify?
Operating businesses do qualify if they meet certain requirements. Generally speaking, there has to be a nexus to the opportunity zone. So substantially all the assets, I think it's a 70% test for the operating business, or a majority, over 50% of its gross income has to be generated in the opportunity zone. And so, while a lot of the activity we're seeing is focused on real estate redevelopment, there's certainly opportunity for venture-style investments and opportunity zone operating businesses as well.
Yeah, you mentioned a 30-month period for developing property which may or may not have a building on it already. Is there, I know 90% of the assets have to be in qualified opportunity zone property, but there's a 30-month period to develop. Is there a safe harbor associated with that to make sure that, the 90% asset test isn't violated?
Right. So the 90% asset test is the critical test for the fund. Yeah. But cash doesn't qualify. So the question is, how do you deploy the cash in a qualified manner? And so there is a working capital safe harbor that the fund can avail itself of, which says, as long as you have a development plan to deploy cash within 30 months into qualifying property, and then you actually deploy the fund's cash in accordance with that plan, the fund will not fail the 90% test because it holds cash effectively. So that is a feature that came out in the interim Treasury regulations that's answered a lot of questions for a lot of real estate developers.
So who do you see either already taking advantage of, or who do you expect to see taking advantage of this program?
The primary beneficiaries from the sponsor side seem to be real estate developers. The real estate developers that may have already targeted properties or assets or pre-developed or entitled properties in opportunity zones and have a little bit of a head start, maybe are closer to shovel ready, seem to benefit the most, given the time compression that we've talked about, the 180-day requirement for the investor to invest their cash into the fund, and then the 30-month requirement for the fund to meet the working capital safe harbor for redevelopment using cash. So those real property developers that have projects that are ready to go are positioned best to benefit from this program. Certainly on the investor side, anyone with tax appetite to defer capital gain, high net worth individuals, family offices are very well positioned to take advantage of this program. And then the true beneficiary, though, of course, is the community, the opportunity zone itself, where capital deployment and capital formation will be increased, and redevelopment activity and growth opportunities for businesses operating there should follow. So that's the whole idea of the program.
Tax cuts and jobs.
That's right.
That's right. Well, thank you, Wyatt.
Thank you.